Welcome everybody to the Homebuyer Boot Camp. I'm Dave Sullivan here with Sierra.
Hi, everybody.
What I love about People Driven Credit Union working here is that they allow me to have my own opinions on things, and that's what we're going to be sharing here. Sierra and I have a lot of background that we'll get into. All this information you should consider this information ours and not the credit unions, and that we're just sharing our own opinion. Please verify all of the information, do your own research. This should just be part of the journey, but we're hopefully going to provide you some value. We appreciate your time here. We appreciate everybody coming in and spending a little bit of time on, the home buying journey. And it should really be considered more of a marathon than a sprint. If you really want to get a home, now is not an easy time to get a home, but you want to have all your ducks in a row so that when you apply for that mortgage or when you make that offer on the home, you're more likely to get that house than not. All right. Well, as I said, I'm Dave Sullivan, VP of Marketing here at People Driven Credit Union. I'm born and raised in Michigan, grew up in Livonia, went to Western Michigan University, and then actually owned a credit bureau for a number of years, was in the credit industry, providing information to mortgage companies and banks, and launched my own credit company out of my car, and then sold it a few years later. 2010, as part of my career in the credit industry, I launched the Credit Guide TV, a YouTube channel. That channel went on to have 10,000 subscribers and a couple million views on videos about how people can improve their credit on their own, that they don't really need a credit repair company. I'm not only a licensed realtor, I'm also a formerly licensed builder and a home appraiser. So I've really been involved in real estate my entire career. I just really enjoy real estate. In addition to that, I bought, fixed up, rented, and sold 10 homes in Garden City. I built my home. I built the home I'm in now, and I built the home next door. I feel like I have a pretty good breadth of knowledge. Sierra has a lot of input as well. Sierra, would you like to tell them a little bit about yourself?
Hi, everyone. I am Sierra. I'm the Innovation and Brand Experience Lead at People Driven Credit Union. I've been with them a couple years, working my way up from a marketing intern to my position now. I was also born and raised in Michigan, right in Allen Park, if you guys know that downriver area. And I graduated from the University of Michigan. I actually double majored in business and communication. So that's how I ended up in the marketing industry. And I'm a part-time content creator for brands, and then I'm also a licensed realtor like Dave as well. So we do kind of bring a lot of that insider knowledge, and we're so excited to share it with you guys. He is going to do most of the hosting today, but I will be checking the chat. So like he said, throw your questions in there, and then I will say them out loud to kind of grab his attention.
Perfect, Sierra. Thank you for that. So we're going to keep this relatively short, but we're going to have 5 classes covering each specific part of the process. We're going to have a mortgage originator. We're going to have a home inspector, an actual and appraiser. We're going to have a title company to walk you through the closing day. And then house hunting like a pro is going to be Sierra and I again for that part of it. But right now we're going to talk about preparing to home shop. And a lot of people start looking online before really getting ready to shop. And it can be disappointing when you find something you like and you're not really ready to put in an offer, or you're not ready to put in a strong offer. So that's one of the things that we're going to be talking about today, is how to get yourself ready to buy a home. And buying a home is so important, I think, to the financial stability of a community and the person's family as well. It can really be the center of your family, gathering place and a safe space. And it's really part of the American dream. It's something we've all wanted to do. Many of us wanted to do growing up. I certainly did. There's some tax benefits. You should talk to your accountant about it, but sometimes usually interest on a mortgage is tax deductible. So there are tax benefits as well, but I consult your accountant or your CPA about that. And it gives you control over your living space. You might have a backyard, whereas if you rented, you can't really make the improvements that you'd like to do in a apartment or a rental home. But when you have your own house, you can actually make the improvements the way you want. Credit is really the most important part, I think, and it may be because I owned a credit bureau, but credit is the most important part when you apply for a mortgage, because even someone who makes $1 million a year, if they have a very low credit score, they won't be able to get a loan. So the higher your credit, the better. Now, a lot of people say, well, credit do I need? Sierra, do you know what credit people normally need for a conventional mortgage?
Some lenders that I've worked with were able to finance some of my buyers as low as I want to say 580.
580 is the very lowest credit score you can have, but usually the rate on a mortgage with a 580 credit score is going to be very high.
Yeah.
So if you really want to qualify for a conforming mortgage, 640 is kind of the basement, right? And you still might pay a little bit higher than the best credit. So it really goes from 580 to 720. Once you get to 720 and above, you're going to get the very best term on your mortgage. People Driven Credit Union is open to working with people with all credit types. And if you don't qualify now, we can certainly help you improve your credit to the point where you can get a better rate, or even get into a mortgage now and then work your way up with that mortgage being a key part of your improving credit score. They look at credit score, but they also look at debt to income ratio and they look at your payment history. Those are the three kind of keys when you're applying for a mortgage. You want to make sure you get the highest possible score you can get prior to applying. So when we talk about debt to income ratio, what you're doing is you're taking all of your payments that you make, your house payment, your rent payment, or actually the house payment that you would have, your auto, your credit card, your education loans, and you divide that by your monthly income, and that will give you a debt to income ratio. And there are some standards that are not set in stone, but people generally look at debt to income ratio at 28 and 36. We'll get to that in a second, but it's key that you keep your debt to income ratio as low as possible. And the high end of those things we're going to talk about in the next two slides. That's how you come up with your debt to income ratio. Your lender is normally going to calculate that for you based on the information that comes from the credit bureau. Now we're going to jump back to credit scores again. We kind of went into this a little bit, but the scores go from 300 to 850. That's a FICO score. FICO is still the company that the Fannie and Freddie use to evaluate a mortgage. A lot of times you can go out and get a copy of your credit score from Vantage or from one of the three repositories, and it will not be a FICO score. So while you might see a credit score, it might not be the exact one that a mortgage lender will use. Some credit scores look at other things differently than FICO does. But just remember, when you get a free credit score, it probably is not FICO. So when the lender pulls your credit report, it might be a slightly different score than what you have now. Things that make up your credit score, and this is really a kind of a basic look at it, but payment history has always been number one. So you've got to pay on time as long as you can. If you make one mistake by missing a payment, it can really hurt your credit score for a very long time. So number one out of the gate, if you're thinking about getting a mortgage, you have to make all your payments on time. So please make all your payments on time is the number one thing that people look at. Now, credit utilization, that is the amount that you owe compared to the original amount of the loan. So if you get a credit card and you get a $10,000 limit and you have a $900 balance, you've got a 9% utilization on that account. The lower, the better, right? So 9% is really what you want to keep your credit cards at if you can. But every time you bring them down to 50% or 30% or 9%, your credit score will go up from a credit card perspective. Now, on an installment loan, you don't have to worry about that because you're making the set payments every month. But on a revolving account like a credit card, you're going to want to make sure that get your balances down as low as you can before you apply for that loan or you get pre-qualified for that loan. Sierra, did you want to add anything to that?
I was actually gonna ask you, I know we spoke before about not completely paying off a credit card. You kind of want to have a little bit of a balance, is that right?
Yes, you're better off with a little bit of a balance rather than zero. If you have a zero balance on your credit card, especially if you haven't used it in a while, it's going to look like you're not using that card. Whereas if you have a little bit of a balance on there and then you're still paying it on time, it gives you more points for that, right? So you don't necessarily want to pay them all down to zero. You want to pay them down to 5 to 9%.
And one more thing, because I know this is a common debate I see people talking about, is closing out a credit card once you have paid it off. That's a no-no, right?
Yeah, you definitely don't want to do that because the length of credit history, as you can see from the next item on that list, is very important. Like if you wanted to have a perfect credit score, you're going to need a credit history at least 20 to 25 years old. Meaning not necessarily that you had a loan that is that old, but if you had a mortgage, a 30-year mortgage, and you're right at the end of paying that off, or if you had a credit card for a very long time, that's one you'd always want to keep. Really, like Sierra said, you should never close any credit cards before you're applying for a mortgage because you want to maintain that credit history as long as you can. So yeah, that's true, Sierra. That's a very good point. New credit. So when you're getting ready to apply for a mortgage, you don't want to start the furniture store. You don't want to go shop for a car. You want to just don't apply for any credit prior to applying for a mortgage. And then mix is important, but not as important as the rest of the items, meaning that you want to have an auto loan, you want to have an installment loan, you want to have a credit card, you want to have a mortgage, right? You want to have a mix of credit. But again, a mix of credit is good, but if you're late on making payments, the mix of credit is not as important, right? Okay, so budgeting for home ownership. You got to understand your income versus expenses. It's very basic stuff, but trust me, I know you can spend yourself into debt very easily, especially nowadays with inflation and everything. One of the things that I try to do, and I try to do it constantly, is that if I have something I don't use anymore, whether it be tools, an old set of rims, an old patio furniture, I put it on Marketplace. And even if I only get 5, 10, 20, 30 bucks for it, at least I'm getting rid of stuff that I don't need. So I do that all the time. I'm always selling stuff on Marketplace. And another thing is you're trying to declutter anyway if you're going to move. So if you find yourself with more expenses than income, I would definitely try to tighten the belt if you're going to apply for a mortgage and then start selling stuff that you don't need. I have friends that have storage facilities. They pay $600 a month to keep all the stuff that they don't need in a storage facility. Don't do that, right? Sell all that stuff, and let that help you get prepared for your mortgage. Now, we talked a little bit about debt to income ratio in the 28-36 rule. So 28%, you don't want to be any higher than 28% for your mortgage, and you don't want to be any more than 36% of your debt to income ratio. If you remember that ratio, you have your debts, monthly payments on the debts, and then your monthly income. That's your debt to income ratio. So 28 for the mortgage, 36 for all of the debt. You don't want to be any higher than that. That is a very old kind of rule of thumb. Okay. There are exceptions. You can waver from that, but that's just a guideline, right? So that that ratio is you can figure it out for yourself. You don't need to rely on a loan officer to tell you. Another quick formula, and I like this one, is multiplying your annual income by 3 to 5 times to get you an idea of what kind of house you can look for. Because you should be looking for houses, and that's something we'll cover next week. But how do you look for houses? How do you find the right place? You should always be looking, but you should have an idea of how much you can afford. So you're looking kind of in the right bracket. Wouldn't you say that's true, Sierra?
Absolutely.
And then you want to create a savings plan. Now, if you're a member of People Driven Credit Union, you have access to GreenPath. You can contact them. They will be happy to walk you through any kind of questions, or they can go over your budget with you. GreenPath is a not-for-profit organization that was started by credit unions to help educate people and get people through budgeting difficulties. I would encourage you, and actually when we send out the follow-up, Sierra, to this, could you make sure that we put in the link for the GreenPath information, that if you want to talk to somebody, I believe there's no cost for the initial talk, and a lot of it is free. It is provided to the members of People Driven Credit Union. Please take advantage of that. If you're wanting to set up a budget or go through some things, they're great. It's a great organization. I've always looked up to them.
Yeah, I'll definitely add that link. Really quick, we do have one question from Keisha. She asked, how long should you wait to apply for a mortgage after applying for a new credit card? or any type of credit?
You don't have to wait. So when I say don't apply for anything during the mortgage process, because anything that you apply for during the mortgage process, you're going to have to explain to the underwriter. You know, I wouldn't tell you to wait after you got the credit card. I would apply, don't let that stop you, but know that while you're going through the process, you don't want to apply for any more credit.
Yeah, well, me personally, this is what if I don't need a credit card, if it's not anything urgent, I wouldn't really look into having any hits on my credit anytime before I want to do a mortgage. Obviously, you could, but that's just a conversation you and the lender would have to have.
Sure. Now, you guys should all know that I have been very involved in credit my entire life. I have 2 credit cards. That's all I have. 2, an American Express and a Visa, right? People driven credit union, Visa, American Express, and that's it. So you don't need a bunch of credit cards. Now, if you want to get points or a discount and all that stuff, that's fine. But wait, don't do it during the mortgage process. That's all. So the cost of home ownership. Now, upfront costs can really range from 3 to 20%, as it says. There are some programs where you can get first-time home buyers can get some additional help, but generally you can go 3% FHA to 20% down conventional. And when you do 20% down, what you avoid is PMI, private mortgage insurance. So if you can get to 20%, I would say do that to avoid the PMI. Now, what is PMI? PMI is a insurance company that insures the mortgage for the lender so that if you don't pay, they cover the difference between what you defaulted on, what someone would have defaulted on, and what the actual mortgage was for. The thing is, though, don't wait to save up 20% because every year homes are going up, right? So if you're just like, I'm going to save $10,000, I'm going to buy a house for $50,000 and I'm going to save 10. So you're trying to save 10. Now the houses go from 50 to 100, right? Don't wait. You're better off getting 3% down with an FHA mortgage and PMI than waiting because you'll never, it's like you'll never get there. So don't wait. But things you should consider ongoing costs, right? You've got your mortgage. And another thing I would recommend is having an escrow, right? Some people are pro escrow, anti escrow. I'm pro escrow, which means that every month you make a payment, you put a little bit of your payment away for taxes and insurance on the property. I've had it both ways. And the problem with not having an escrow is if you do have a mortgage, all of a sudden you've got a $5,000 bill, right? Your taxes come due. And you're like, oh, I forgot to save for this. Speaking from personal experience, I am pro escrow. So if you can put the money into escrow, if you want to have an escrow, I would do it, right? But some people don't, but I recommend that you do. Maintenance in utilities. Now, this is going to come up during our appraisal and home inspection class that we're going to have in a few weeks. Before you buy the property, you should really have an idea of the age of the roof, of the furnace, of the hot water tank, of all of the big things that are going to probably break. And you can get a home warranty, which I would highly recommend. Get the home warranty. But when you're thinking about home ownership, a lot of times you won't have to cut the lawn at someone who would live at a apartment. Well, now you've got to get a lawnmower, right? Or you got to pay somebody to do it. So there are additional costs that you're going to incur if you're a first-time home buyer that you might not really think about. All right, so let's talk about an example, right, of what payments and price and all things like that. If you were, it is a hypothetical house in, let's say, Metro Detroit, if the price was 200,000 and you to do 10% down, that's 20 grand. Now, as we talked about, you can do 3% down. Closing costs, you've got $800. Now that'll be like and this we'll go over at the last class about title fees, title insurance, appraisal, processing fees. Sierra, you got anything else? What else is in the closing package?
I think
Points. You might have points depending on what mortgage you pick. So $8,000, you can get there pretty quick is my point. Oh, and you have to prepay the taxes too for a year.
Mm.
All that'll be in there. And that's part of the upfront cost. Mortgage payment, 7% is, we're a little bit lower than that, but not much. So that's what that payment's going to be. Property taxes, if you roll that into the escrow, along with maintenance and utilities, if you put 300 away every month for that, hoping that, you won't need it. But about 2 grand a month is what you're looking at in this scenario, which is pretty close to what you can rent a house for now. It's not too far off, and you're building equity. You're not making the landlord rich, right? You're making yourself. You're building equity in the property. And the one thing that will appreciate against the dollar, I guess you could say it that way, is a home, right? Homes have historically been a great store of wealth. Another thing you have to realize that if you get a 30-year mortgage, 19 might be a lot right now, but 10 years from now, 19 is not going to be that much. And rent will have gone up for 10 years. So in 10 years from now, you're probably going to be paying less than a renter would pay for the same house. And then for the next 20 years, it goes down even lower. What do you
Dave, we have one question,
think? Okay,
back about credit. Says if
sure.
you had a bankruptcy 4 years ago, will that stop you from getting approved for a home?
No, bankruptcy does not keep people from getting a home. People should not be afraid if they had a bankruptcy to apply again. Usually 2 years is what you need to wait. So if you're 4 years, you're fine. So you want to make sure you get your credit back up, and it can recover quickly if you do it the right way. 2 years is all you need to wait on a bankruptcy. Sierra, did you want to touch on anything more on the example scenario here that we put together?
No, I would say that I don't think in there is included if you had a potential mortgage insurance payment. But I will say don't fear if that is the case that you do have to have the mortgage insurance. Me personally, I'll be completely transparent. I in my 20s did not have 10 or 20% to put down on a house, and I was still able to purchase a home with the PMI. And actually, I'm coming up on 2 years of owning a home. I believe I can call and get that taken off now, right, Dave? Because it's either
That's exactly right.
10 or 2 years you have to reach before you
Yeah.
take it off.
So what you can do is after you go along in your mortgage for a while, if the equity in the home comes up to the point where you have 20% equity, they will take the PMI off and you don't have to refinance or anything. So if you have PMI, it might be 150. Do you know how much yours is, Sierra, as
It
an
was right
example?
around $100.
Okay. So she won't have to really do anything but make a phone call and her mortgage payment will go down $100 a
Mhm.
month. So that's pretty good.
I'm excited for that.
Good. Yeah. Saving for a down payment. Well, there's a couple ways. I think there's a way for people to save for a down payment at People Driven Credit Union, if I can do a shameless plug. We have something called Round Up to Win and Save to Win. Sierra, are you familiar with those programs?
I would say I'm very familiar.
Yeah. So when Sierra was an
Great
intern, we kind of
program.
came up with that idea and we did a video on it. You can put money into a CD, and then every time you put $25 away, you're entered into a drawing where you can win up to $5,000 every quarter. And that's industry wide, but we have people win 100, 1,000, $500, and that would really go a long way towards saving for a down payment. So, and you're building up savings in a very safe and secure CD. To savings, right? Like in a Save to Win program would be great. Additional income sources. They are delivering groceries for large retail chain, and they make a ton of money on tips. So it's not like driving for Uber where you got to drive all over the place. You just come out of one store into neighborhoods by that store, and you get an hourly wage, but you also get tips. And I think the tips will be free of taxes at some point. So, and tax refund season coming up. That's a great time to kind of put some money away or add your funds to that. Like I said, the high yield savings accounts. We have money market accounts that pay a bunch too, that you don't have to lock the money up in. So you can scan that QR code, Sierra. Nice job putting that in there to check out the options if you want.
Just trying to make it easier because we do have a lot of great savings options.
There
Okay, we
are
have
there.
one question. Right now Michigan is giving 25,000. How much would you have to put down if the house is 200,000, or is it the same? I think that's, I don't, I think they're
There's
talking
a
about
new
down
MISTA
payment
program. There's a
program.
new MISTA program out there. If you're a first generation home buyer, I think they will give you $25,000 towards your down payment and your closing costs. But let's wait for the mortgage person to give you the details on that. But it would be the same. So if you were able to get that grant, now I think that if you keep the house for 30 years, you don't have to pay it back. But if you sell the house within like 5 years, there's a portion of that you're going to have to give back. But MISTA is a great option. I've actually spoke at the MISTA conference for 5 years. It's a great thing that we do here in Michigan to help people kind of get past that down payment. But if you go out there and search MISTA, and it's MSHDA, home buyer down payment assistance. If you Google that, it will explain more about the program. But we'll definitely have Karen or somebody from Member First Mortgage talk about that when they're on the mortgage class. Did you heard about that, Sierra, already or no?
Yeah, I know there's always a couple different programs going on, but they do have some special requirements, and that's important because you don't want to get stuck having to pay
Yeah.
back if you didn't fully know what you signed up for.
Right.
But again, that's a conversation for the mortgage people, and we'll go deep
Yeah.
into that when it's time.
It's important to find out from them because things change all the time. So what is a pre-approval? A lender, so you'll apply with a lender. Now, you should not do this when you found the home. You got to do this before, right? They're going to pull your credit score, do your debt to income ratio, look at your assets. Do you have a 401k? They're going to look at all this together and going to put it together in a folder. And they might actually run it through the Fannie Mae automated underwriting system and get a pre-approval right from Fannie. Okay. And that's the most important one that you want because you're basically clear to close depending on the property. So you've already gone through the mortgage process at that point and you're just waiting to plug in the property. You can close a lot faster. You can close in less than 2 weeks if you get everything ready prior to making the offer. And I've seen people close even in less time than that. So it really is important to do the things that we talked about with your credit. Tighten up your savings, get a little bit ready, but then go and try and get a pre-approval, right? Right through Fannie and Freddie. And that's something that Member First Mortgage does for us. So if you're looking to get pre-approved, that's the right way to do it. Not just going to somebody and they give you a letter that says, oh yeah, they're pre-approved. But if they don't run it through Fannie and Freddie, you don't really know.
Yeah, that would be the difference between pre-qualified and pre-approved,
Right.
which a lot of realtors with the new laws that have come out in real estate, a lot of realtors will not even let you go see a home unless you are pre-approved.
That's
And so
right.
that's why it's really important to, choose your team wisely and get all your ducks in a row. But those are conversations you'll have with those professionals when the time is.
You can get a free copy of your credit report all over the place. Actually, you can get it from us in our app. If you have our app, you can get an idea of what your credit score is right now. Now, remember that is the Vantage score. So it's not going to be exactly the same, but it's going to be very close to what FICO is going to give you. So it's tax time. It's a good time to get your tax information together. You need 2 years for W-2 tax returns, bank statements. I think the last 3 statements, right, Sierra? For
I
bank
believe it's
statements.
three.
Last 2 pay stubs, proof of employment, which would be the pay stubs, and identification, like your driver's license, is what you need. Definitely compare lenders. You can consider us, but also, you can shop us too. We don't have anything to hide there, and do the best that's for you. I really believe that People Driven is a great place. I have my mortgage with People Driven, and I like that it's all in the app together. We've got some great programs, but definitely shop. You should really like any contractor, you should get 3 bids, right? You want to get 3 bids if you need a new toilet, 3 bids if you need a new dishwasher, 3 bids if you want to do your mortgage. That's what I would recommend. So you submit the mortgage application, make sure that you tell the lender that you want a Fannie Mae approved or Freddie Mac or whoever they're going to use approval letter, meaning that you want to be run through the automated underwriting system and you want that kind of an approval. Now that might require that you get more information and that's another mortgage loan officers can only do what you give them. So if they come to you and they say, hey, I need this, and even though it might seem dumb, they need that for an underwriter. The underwriter is asking them for more information. So please get that information back to them as quickly as possible. Don't wait. Don't delay. They need that information. If you get it back to them quickly, they're going to take care of your file first, because the people who aren't getting back to them quickly are going to the side. You are in control of your mortgage process. Here is a great pre-approval checklist that GreenPath has put together, and we will send these all out later, right, Sierra?
Yep, we can send it in the follow-up email, or if you're on a computer, you can just scan the QR and it should open right on your phone for you to get started on right away.
Yeah, I really like this. It's a great checklist. It kind of covers everything. And you can just work right through it on a Sunday afternoon and be ready to go. So I would definitely download this. Okay, we'll get into a little bit. Now, remember, we'll have the mortgage lender explain all of them, but the typical types of mortgages, or the common types, are conventional loan, which just means a regular no frills type of mortgage, where most of the mortgages are like this. Now, an FHA loan is where you have the lower down payment amount. They have a little bit more flexible on their credit requirements, but the inspection, the appraisal has to be an FHA appraiser, and they're going to be a lot more stringent on the condition of the home, right? Because FHA has more risk to them because they're taking a smaller down payment. An FHA appraiser is going to really go through the home and look at all of the defects and anything that needs to be repaired. They're going to have to, the seller or the buyer is going to have to make those repairs before they close. And usually it's a seller. And the seller might be a little more hesitant. But if they have two offers for the same amount and one's conventional and one's FHA, they might go conventional just so they don't have to worry about the FHA requirements that have to be done. A VA loan is for veterans, and it's a great option if you are a veteran. We do a lot of VA loans here, and a way to say thank you, right, to our service people. There are fixed rate mortgages. We have adjustable rate mortgages. Now, a fixed rate mortgage means that you sign and it's the same payment the whole time. Now, adjustable rate mortgage means that you sign, it's the same amount for a certain amount of time, and then it will adjust based on where the prime rate is, right? If you closed an adjustable rate mortgage 2 years ago, and now you're going to adjust, it could adjust up or down depending on where the rates are now. I have a 6-year adjustable arm. So mine is going to be fixed for 6 years, and then it's going to go however it goes for the adjustment. Now, I did that because I got a lower rate. So for 6 years, I got a lower rate with the option that it could go up or down in the future. ARMs are great tools to use, but someone who's conservative and they just want the same payment for the rest of their mortgage, 30 years, fixed rate mortgage is going to be probably the best choice for you. Common home buying mistakes. I could have wrote a book on this one because I've done them all. Well, not checking your credit early, right? Shopping for a home before you know where your credit is. Not saving enough for upfront costs. Another problem, right? Making large purchases before the close. Yeah, so after you apply, before you close, if you get a new car or new furniture and all that stuff, I've seen people buy furniture for the house that they thought they were going to close on next week and then not qualify, and they lose the house. Don't buy anything during the mortgage process. I mean, anything. That's when you should be selling the stuff and living off the cash and paying everything down during that entire process. And it can be about a 30-day, maybe 40-day process if you, right from the beginning, when you approach a loan officer and then close on the loan. You should expect 40 days, kind of count on 40 days. So hidden costs, property tax, homeowners insurance, right? HOA fees, you gotta check for those, especially for a condo. Condos can have very high HOA fees. I've seen them up $500-$600 a month. Do not ever, under no circumstances, do you ever skip the home inspection. And not only do you, and we'll have an inspector on later, but not only do you not skip the home inspection, you have to go there and you have to walk right next to the inspector the whole time. And then he's going to point everything out as he sees it. You've got to do that, unfortunately. And it can be a 2 to 3 hour process depending on the size of the property and the inspector. But you've got to be right next to him the whole time. You've got to know what he finds. And if you see it, you're better off. There's like mold. I was in this one house and it had like this, it looked like suds on the bottom of the wall. And that was the salt leaching in from outside. And I wouldn't have known that if I wasn't with him, but it had a water problem down there. So you've got to be with the inspector. Do not skip the home inspection, and please get a home warranty. So again, we talked about the resources that we have here at People Driven, how to save, how to get some credit counseling if you want that, Green Path Financial Wellness. Do have first-time homebuyer programs that are specific for people who are just trying to get into that first home. I think Carla attended one of these classes. She's now the branch manager in Romeo, but she attended these classes. She got her credit score up, I don't know, 50, 60 points, applied for a mortgage, got her first home, and all it was from all these classes. And actually, you can watch the video on our homepage of Carla down towards the bottom. She talks about the process that she went through. But there are a lot of different things that we can help out with, and we are happy to do them. Now, next week, 1 week from today, we're going to have a class on
House hunting like a pro.
House hunting like a pro. So how to actually find the houses. And I'm going to log into RealComp. They got a lot of statistical information about home prices and what's coming on the market, what's not there. We're going to share all that information with you. It's going to be pretty phenomenal. Yeah. Now, if you stuck around to the end, you can, if you come to the Southfield office and you talk to Will, who is our chief security officer, and you tell him that you were in this class, he will give you a valuable hat. You can get a hat just like this one from Will, and give him my name, tell him you were on the class, and he'll give you one of these hats. Okay. Thanks everybody for attending. Sierra, thanks for doing a great job on the presentation. I appreciate that.
Of course.
We'll talk to you next week.
Bye, everybody.